All right, Drew Rathgeber here real quick with profuturestrader.com with a very quick video on margins. And just realize margins can change at any time. But if you go to profuturestrader.com and you scroll to the very bottom of the page, you'll see a page called contract margins. But just realize these are not concrete and can change at any moment in time, from the exchange down to the FCM, and they can actually even ramp them up based on FCM exposure. And they may change from one FCM to another as well. So there's a lot of variables you need to think about when it comes to the margin aspect. But this is just a basic overview of what they are. So like right now, you've got the 100 ounce silver contract. Initial margin is $1,196. So what that means is for every contract or 100 ounces of silver, you need to put up at least $1,196 to control that, okay? So let's say silver's trading at $80 per troy ounce. That's $8,000 worth of product, and you need to put up a minimum of $1,196. I do not recommend doing the minimums. You might want to do 2, 3, or 4x this, but this is the minimums. And I don't actually personally recommend doing the minimums because it comes with the highest degree of leverage, which equals the highest degree of risk and even possible debit risk and margin calls. Now what we would come down to is the maintenance margin. So what that means, maintenance margin is if your account value, let's say you bought one contract, you put up $1,196, and your account balance drops below $1,087, they're going to want you to put more collateral, more money. It will create a margin call situation. And you need to bring your account above a net liquid value of $1,196. So again, why I don't recommend using minimum margins. And just realize this, in a typical environment based on the contract worth or value, the exchanges will set the margins from anywhere between 4 to 10%, okay? However, we just had a very interesting situation with the metals where they raised it to almost 20% based on the volatility and overall size of the contract. The size of the contract went well over 5,000, let's say gold, went well over $5,000 per troy ounce. I believe it was at 5,600 or 5,700, around that range. So on a 100 ounce contract, it was just an astronomical number, over $500,000 worth of metal you would be controlling. So they changed it to percentage base, okay? And it was almost up to 20%, I believe, contract value. And it does change. They were ramping it back and forth. They were, one day it was 16%, next day it was 19%, and it was 17%. So you're gonna have to make adjustments when it comes to margins and realize it's never in concrete. It can change on a dime and force you to reduce your positions. It's just the way the game is played because of the leverage ratio in the volatility markets. They're just trying to protect and cover everyone's asses, really, at the end of the day. So this is a basic guideline of margins, and generally speaking, this should be right on it in a normal market environment. This should be relatively what you should be looking at. But again, it can change from even from FCM to FCM. The margin requirements that they are requiring could change as well. So that's why I'm an IIB. I do trade through multiple FCMs because I have some clients that want some cheaper margins versus another FCM that maybe have higher margins. So just realize this is never in concrete, always changing. I think a lot of people get that wrong and not realize that it can change on a notice. So that is how margins work. Go to profuturestrader.com and bookmark the margins page. Take care. Bye.